Hello and welcome back to the Wall Street Petting Zoo. This is our This Week at the Zoo segment, which is our weekly news segment. I'm Christopher C. Smith.
And I'm Robert Coburn.
And this week, Robert, the market moved higher on Monday on optimism around the China-U.S. trade talks from the previous week. We had news that a temporary resolution had been reached and that we got a phase one deal signed on. It'll be signed on the first week of January. And the reports are that the agreement will have the U.S. reducing the tariff rate on about $120 billion of Chinese imported goods from 15% to 7.5%, while we'll be maintaining an existing 25% tariff on another $250 billion in Chinese imported goods. There is, however, no additional information released this week on the agricultural purchases that China has promised to make. So we don't really know what's going to happen with that or when those purchases are going to go into effect.
It's a nice Christmas gift for the stock market.
It is.
And Tuesday, we got strong housing and manufacturing data for November. Both these sectors have been struggling lately, so the market reacted really well to this news. Real estate stocks had an especially good week on the strong housing numbers. With regard to manufacturing, keep in mind that these are the numbers for November, and the outlook for manufacturing has changed in December. We did get some tariff relief, but we've also had this suspension of Boeing 737 MAX production. I believe they will be halting production in January. They also have a backlog of actual stock of planes that they've produced. But because keep in mind, they haven't actually sold any more. I believe in March is when they stopped selling them. But they didn't stop producing them. So they basically just have this whole backlog of planes until Boeing and GE can figure out what's going on between the two, what's causing all the issues with the 737 MAXs.
Yeah, that's a pretty significant hit to U.S. manufacturing. GE was heavily involved in manufacturing the engines for those jets. And so not only Boeing, but also its subsidiaries took big hits in their stock prices this week. And I think it's going to be really negative for the manufacturing sector. The reason that the manufacturing numbers for November look so good was that the GM strike ended and all of those GM workers came back to work and they resumed manufacturing GM automobiles. So it's some good news for manufacturing, but it's definitely once the suspension of Boeing 737 MAX production goes into effect, we're going to see, much worsening outlook for that manufacturing sector. Thursday, the stock market seemed unfazed by the announcement of Trump's impeachment. Frankly, it's a slap on the wrist. It doesn't really mean anything unless the impeachment articles could pass through the Senate. Trump will remain president and won't have any significant consequences from this impeachment, much like happened with Bill Clinton a couple decades ago. And of course, the House Democrats have decided not even to forward the articles of impeachment to the Senate. So it appears that not only would it not pass, but it won't even have the opportunity to get defeated in the Senate. Oil prices surged higher on Thursday as China announced that starting on December 26th, tariffs will no longer be applied to imports of U.S. chemical and oil products. This is good news for the oil market. So it moved higher on Thursday, although it paused on Friday. Oil has been on a big run lately, particularly this week. The oil inventory report showed that imports of oil had vastly increased from about 70,000 barrels a day to something over 5 million barrels a day. So we saw a big increase in oil imports last week.
We also had extremely negative earnings guidance from U.S. Steel, which announced Friday that it would lay off 1,500 workers and close a plant in Michigan. This is another sign that it's too early to get excited about recovery in the U.S. manufacturing sector. We'll have to closely watch the manufacturing data next month to see which way the numbers go in December. After hours trading on Friday, Trump signed a defense bill to launch the Space Force, which would become the 6th division of the United States military. This may see a boost in aerospace stocks like Boeing and Lockheed Martin, as there are very few players in the aerospace market. However, of course, with Boeing's launch of its new Starliner rocket that failed on Friday when the vehicle failed to reach its proper orbit in space, this is just the latest in a string of failures for Boeing, and it suggests that other companies may be in a better position to cash in on Space Force contracts. With 5.5 days left in trading in 2019, it's definitely a good time to start looking at stocks to buy. However, if you want a little bit of tax relief, you may want to sell off some of your poor performers.
Yeah, with that Space Force getting established, Robert, I think it may be a good time to buy the XAR fund, which is an aerospace and defense fund. It's one that does not have much exposure to Boeing, and it's one that is at kind of an attractive valuation right now. It's been on a downward slide for a little while, but it has started to recover just toward the end of this week. I think Thursday and Friday it was up a little bit, so it appears to be bouncing. And so with the Space Force going into effect, it's probably a nice time to buy that fund at the current valuation.
Yeah, maybe a good time to buy it, Monday on the open, because he didn't sign that until after the market, well after the market was closed. So the number value, I think it's at 109 right now. So may see a bump up until 115, you think?
Yeah, something like that. I think it's a good buy. There's another aerospace and defense fund that I would recommend you stay away from, which is the DFEN fund. It's a leveraged fund, but its largest holding is Boeing, so it's got a lot of Boeing exposure. Given the bad straits that Boeing is in right now, I think that fund would not be the one that you would want to buy. But the XAR fund, because it has a lot less exposure to Boeing and a lot more exposure to others like Lockheed Martin, I think that's probably a better buy right now. Let's talk stocks we watched this week, Robert. I guess I'll go ahead and go first here. I was watching Baidu. Baidu went on an absolute tear this week, gaining 7.5%. Paused Friday, and it's pulled back a little bit on Friday, and it may pull back a bit further next week before moving higher. But overall, I am still bullish on Baidu. I'm going to buy more shares on the dip, and Baidu has had just an absolute run of good news. If you recall, they had something like 6,000 AI patents that they filed in the last couple months. They've filed more AI patents than any other firm in China. They announced several major partnerships with U.S. tech firms this week, including a collaboration with Samsung to release an AI chip that's going to go into production this coming year. So the stock remains a great value. I think their earnings outlook is only going to improve. It has been the earnings forecasts have been surging lately, and it's just at a great valuation right now. So it's also financially healthy with a $2.5 billion cash reserve and very little debt. I think their debt is somewhere in the $50 million range, which is, makes a really nice comparison with that $2.5 billion cash reserve. So incredibly healthy company. Zumiez, if you recall, I was going to enter at 30 and then add a little more at 31 I was going to enter at 31 and then add a little more at 30 if it hit 30. It did bounce from the $31 level. It didn't get down to 30, but I entered according to my plan at $31, as I laid out in the podcast last week. And we ended the week a few percent higher in Zumiez. I think last I looked at it, it was like 32.50. I expect it to continue rising from here, so I'm holding that over the weekend. Snapchat also had a great week, gaining over 3%. I'm going to continue holding that next week. Aurora Cannabis is the one that didn't go as well as I hoped this week. It struggled after some really extremely negative analyst coverage, suggesting the company doesn't have enough cash on hand to survive for longer than about a year. One analyst even suggested the stock will go to zero. I don't think it's going to be that bad. I don't think they'll go bankrupt, but it does look like they're going to have to take on new debt and issue new shares of stock this year in order to survive, both of which are bad for the share price. So if they do a share offering, a stock offering, or if they take on new debt, both of those will drive down the stock price. So the drop in Aurora Cannabis probably has not ended yet. So I've exited this stock for now, and I will have to reevaluate later in 2020 on looking at Aurora Cannabis again. How about you? What did you watch this week, Robert, and how did it go?
I watched the failing FedEx stock. So as I mentioned last week, that they would probably be posting abysmal numbers, and they most certainly did. Remember, they ended their contract with Amazon, which was probably their biggest customer. With UPS picking up more deliveries for Amazon going into the holiday season, it's surprising that UPS stock followed suit with FedEx at the same time. However, they only dropped a couple of points versus FedEx that dropped 10%. Which could also be a sign that investors and analysts are not expecting huge numbers from UPS since Amazon has ramped up its own shipping services. But it is still reliant on third-party shipping for a majority of their shipping needs. So UPS is definitely going to stay on my radar. And unless FedEx restructures or looks to sign another big customer, which realistically there's no one bigger than Amazon right now, especially in the U.S., then FedEx is going to probably continue to fall until they can stabilize, like either by reducing their workforce or reducing something in their infrastructure that allows them to be more profitable and meet analyst expectations. Another stock I was looking at was CarMax, which I expected them to actually do well, and they unexpectedly reported poor earnings, which caused the stock to tumble trading on Friday. So the poor earnings were reported as a result of advertising expenses and stock-based compensation expenses. With other competitors entering the market, specifically online car retailers like Carvana, CarMax is flooding the market with advertising to keep their grip on the used car market. So it's not far-fetched that the reason why that they are spending so much money on marketing is because there's a lot of new players in the used car market, because it was only up until about 5 years ago when they made it. They cleared all these hurdles that were preventing online retailers from selling cars. So this is the reason why we've only seen online car retailers in the last about 5 or 6 years. Another stock I was looking at was Nike, which they did beat analyst expectations, reporting the first quarter in which their Air Jordan line of shoes had their first $1 billion quarter.
Oh my gosh.
That is a lot of shoes. Because if you think about it, that's roughly about 200,000 people wearing those shoes, more or less. However, due to the ongoing trade war, their profits weren't as strong as they could have been. With trade talks starting to settle, it would definitely be a good time to watch for a good entry point for Nike.
Yeah, boy, the FedEx failure this week, I agreed with you that was going to happen, and you certainly called it on FedEx. It kind of makes me wish that I were an options trader.
Yeah, I was kind of thinking the same thing, but I just don't have the time to to execute options like that. I was just like, I'll just wait.
Yeah, I did actually apply for options trading on one of my accounts this week. So once I get approved, I can play around with that. I don't think that I'm going to do a lot of it, especially on the short side. I kind of feel like why would you play with a disadvantage against the house when the market tends to go up, So I don't know that I will play the short side very much, but it is kind of tempting with failing companies like FedEx, where you see just really clear reasons why that's going to go down. Okay, stocks we're watching this week. I am still going to watch Baidu, Zumiez, and Snap. I think all three of those stocks should continue to do well. I also bought shares of Beyond Meat, Uber, and Spirit Airlines on Friday. All three stocks look undervalued with an improving earnings forecast, and all three are gathering momentum for a move higher. As a dividend investor, Robert, I've also got a couple that you might be interested in. AbbVie and AT&T both still look undervalued. Both have a 5.5% dividend, and both have been moving higher with strong momentum. So opportunity for growth and also opportunity for a 5.5% dividend. So those are both probably pretty good stocks to start looking at now if you're a dividend investor.
Yeah, I'll have to start looking into AT&T. I always kind of try and overlook them because I'm not a fan of their company, because I use Verizon. So the stocks I was looking at, or I will be looking at this week, is Boeing, which we mentioned earlier in the podcast, and how they're doing very bad. Boeing may want to be avoided unless you believe that they will be able to resume production of their 737 MAX planes that they announced this week. that they are pausing production in January. I will be waiting for Boeing to dip below the 300 mark, as it hasn't done that since the tail end of 2018. So that's where I'm looking to enter into Boeing, because, again, there's still not a lot of players in the aerospace market, and I'm pretty sure Boeing will figure out what's going on with those 737 Maxes. I mean, it is a bit concerning that it's almost a year since the planes have been grounded and they haven't quite figured out what's going on. But I'm pretty sure they'll figure it out. I think 2020 will be a better year for Boeing. Netflix reported strong subscriber numbers across all regions this week. Now, my wife watches more Netflix than I do, and she mentioned to me a few weeks ago that she has seen a huge increase in international content. I wish I actually listened to her, because then I probably would have looked at it a little bit more in depth. But after that report on Tuesday, they reported strong subscriber numbers across a multitude of regions. It could be said that Netflix has the strength to coincide with Disney Plus, but I'll also be waiting on Netflix to pull back a little bit before investing any money into Netflix.
Yeah, I think that their valuation isn't, entirely warranted right now. They're a little overvalued, but they're growing internationally, which is huge. They've definitely plateaued domestically and sort of saturated the domestic market, but I think internationally they probably have a lot of room to grow. So that's a great move for Netflix to start adding all of that international content. Good for them.
Yep.
All right. Well, if you liked what you heard on the podcast this week, please give us a like, share, or subscribe. You can comment on the YouTube video. Underneath the YouTube video, if you watch us on YouTube, you can find links to our Facebook and Twitter pages, or you can just search for Wall Street Petting Zoo on Facebook and Twitter. You can also follow us on Podbean and iTunes. So if you prefer your podcast in audio format, you can find us on there. And underneath the YouTube video, you will also find a referral link for Webull. If you open up a Webull account, add $100 to your account, you get a free stock, we get a free stock. That helps support the podcast, which is great for us and great for you. Thank you guys so much for listening. I will be gone next week because I will be away on vacation for Christmas, but Robert will be here with a quick recap of the week. And then we will be back the following week with a full episode. Happy holidays.